Question 1. Topic: Types of annuities. An annuity contract offers the annuitant a choice between a fixed annuity and a variable annuity. The annuitant is interested in consistent, guaranteed payouts, regardless of market fluctuations. Which of the following annuity types would be the most appropriate recommendation based on the annuitant's needs? A. Variable annuity. B. Fixed annuity. C. Equity indexed annuity. D. Deferred annuity. Answer: B. Fixed annuity. Explanation: a fixed annuity guarantees a fixed payout amount, offering the security of predictable, stable income that is not impacted by market conditions. This is ideal for annuitants who prioritize consistency and predictability in their income stream. Variable annuities expose the annuitant to market risk, with payouts fluctuating based on the performance of the investment sub-accounts. This is not suitable for individuals seeking guaranteed returns. Equity indexed annuities tie returns to a stock market index but still carry some market risk, making them less stable than fixed annuities. Deferred annuities refer to the timing of payouts, delayed payments until a later date, but do not necessarily guarantee fixed income, making them less suited to the need for consistent payouts. Question 2. Topic: Taxation of annuities. What is the tax treatment of withdrawals from a non-qualified annuity when the funds are withdrawn before the annuitant reaches the age of 591? A. Withdrawals are taxed as capital gains and are exempt from early withdrawal penalties. B. Withdrawals are taxed as ordinary income and an early withdrawal penalty may apply. C. Withdrawals are taxed as ordinary income but no early withdrawal penalty applies. D. Withdrawals are not subject to any taxation if taken before age 591. Answer: B. Withdrawals are taxed as ordinary income and an early withdrawal penalty may apply. Explanation: for non-qualified annuities, earnings interest are subject to taxation as ordinary income, and if withdrawn before age 591, they are typically subject to a 10% early withdrawal penalty under IRS rules. The principal amount is not taxed as it was funded with after-tax dollars, but the earnings are taxed upon withdrawal. Option A is incorrect because withdrawals are taxed as ordinary income, not capital gains. Option C is incorrect because early withdrawals before age 591 do trigger a penalty unless a specific exception applies, e.g. disability or death. Option D is incorrect because annuity withdrawals are always taxed unless the funds are in a qualified retirement plan, and early withdrawals trigger penalties unless exceptions apply. Question 3. Topic: Suitability and ethical considerations. Scenario-based. Mr. Smith, a 68-year-old retiree, is looking to invest his savings to generate consistent income for the rest of his life. He has a moderate risk tolerance but is concerned about market volatility affecting his income stream. He expresses interest in an annuity product but has no prior experience with financial products. Based on Mr. Smith's profile, which of the following actions should the insurance agent take to ensure compliance with suitability requirements under Washington state regulations? A. Recommend a variable annuity to Mr. Smith, as he has a moderate risk tolerance. B. Recommend a fixed annuity with a lifetime payout option to match Mr. Smith's desire for predictable income. C. Recommend a structured annuity with investment-linked returns to provide growth potential. D. Recommend a deferred annuity with a 20-year payout period to maximize future income. Answer: B. Recommend a fixed annuity with a lifetime payout option to match Mr. Smith's desire for predictable income. Explanation: in Washington state, suitability regulations require that the insurance agent consider the client's financial situation, risk tolerance, and objectives before making any recommendation. Mr. Smith is seeking predictable income and is concerned about market volatility. A fixed annuity with a lifetime payout would align with his desire for stability and guarantee income for the rest of his life. Option A is not suitable because a variable annuity exposes Mr. Smith to market volatility, which conflicts with his concern for predictable income. Option C is not appropriate because a structured annuity with investment-linked returns introduces unnecessary risk for someone with moderate risk tolerance who desires stability. Option D would not align with Mr. Smith's needs, as a deferred annuity delays income which may not meet his immediate retirement income needs. Washington's suitability model regulation requires that agents recommend products that are appropriate for the client's financial situation and goals, ensuring no conflicts of interest and providing full disclosure of risks associated with annuity products. Question 4. Topic: Structure and mechanics of annuities. When considering the payout options for an annuity, which of the following payout options provides the highest level of security for an annuitant, ensuring that they will receive income for their lifetime even if they outlive their life expectancy? A. Life only. B. Life with period certain. C. Joint and survivor. D. Lump sum. Answer A. Life-only. Explanation: the life-only option ensures that the annuitant will receive income for as long as they live. However, payments stop upon their death, and there is no guarantee of beneficiary payouts. This option generally provides the highest monthly payouts since it carries the most risk for the insurer. The annuitant may live much longer than expected. Option B. Life with period certain, guarantees income for a certain number of years, but if the annuitant dies early, the payments are passed to the beneficiary for the remaining period, which reduces the monthly payout. Option C. Joint and survivor provides ongoing payments as long as either the annuitant or the spouse lives, typically at a reduced rate compared to the life-only option because it guarantees income for 2 lifetimes. Option D. Lump sum involves a one-time payment and does not provide ongoing income, making it unsuitable for annuitants seeking guaranteed lifetime income. Question 5. Topic: Taxation of annuities. An annuity contract was purchased with non-qualified funds. The annuitant has made a partial withdrawal after several years, and part of the withdrawal includes both principal and earnings. How will the earnings portion of the withdrawal be taxed? A. The earnings are taxed as ordinary income and subject to a 10% early withdrawal penalty if the annuitant is under 591 WO. B. The earnings are taxed as long-term capital gains, regardless of the annuitant's age. C. The earnings are taxed as ordinary income but are exempt from the 10% early withdrawal penalty if the annuitant is over 591 WO. D. The earnings are taxed as ordinary income but are exempt from any early withdrawal penalties. Answer A. The earnings are taxed as ordinary income and subject to a 10% early withdrawal penalty if the annuitant is under 591 WO. Explanation: for non-qualified annuities, the earnings portion of any withdrawal is taxed as ordinary income, not capital gains. If the annuitant is under 591 years old, the IRS imposes a 10% early withdrawal penalty on the earnings in addition to the regular income tax. Option B is incorrect because the earnings are not taxed as capital gains, they are taxed as ordinary income. Option C is partially correct in that earnings are taxed as ordinary income, but the early withdrawal penalty only applies if the annuitant is under 591 WO. Option D is incorrect because the early withdrawal penalty still applies unless the annuitant meets an exception, e.g., death or disability. Question 6. Topic: Annuity riders and options. Which of the following riders would be most appropriate for an annuitant who is concerned about needing long-term care but still wants to maintain their annuity income stream? A. Guaranteed minimum death benefit GAB. B. Long-term care rider. C. Guaranteed lifetime withdrawal benefit. B. Inflation protection rider. Answer B. Long-term care rider. Explanation: a long-term care rider is designed specifically for individuals who may need long-term care. It allows the annuity's death benefit or withdrawal benefit to be used to pay for long-term care services while still providing an income stream for the annuitant. This option would address the annuitant's concern about needing long-term care while maintaining their income stream. Option A, GMDB, ensures that the annuitant's beneficiary will receive a minimum death benefit, but it does not help with long-term care needs. Option C, GLWB, provides a guaranteed income stream during retirement but does not address long-term care needs. Option D, Inflation Protection Rider, adjusts the annuity payments for inflation, but it does not specifically address the annuitant's long-term care concerns. Question 7. Topic: Suitability and ethical considerations. Scenario-based. Ms. Miller, a 55-year-old professional, has recently received a significant bonus and is considering purchasing an annuity to supplement her retirement income. She has no dependents and prefers flexibility, as she may need to access some funds in the next few years. What should the insurance agent recommend to ensure compliance with suitability regulations under Washington state law? A. Recommend a fixed immediate annuity with a lump sum payout option to maximize her retirement income. B. Recommend a variable annuity with sub-accounts and growth potential, which aligns with her preference for flexibility. C. Recommend a deferred annuity with a long surrender period to lock in her retirement savings. D. Recommend a flexible premium deferred annuity to provide both flexibility and potential for future growth. Answer: D. Recommend a flexible premium deferred annuity to provide both flexibility and potential for future growth. Explanation: Ms. Miller is seeking flexibility with access to her funds and the potential for growth, making a flexible premium deferred annuity the most suitable option. This annuity allows her to make ongoing contributions and defer the payout, offering both the flexibility to access funds and potential for growth based on market performance if invested in a variable sub-account. Option is not suitable because a fixed immediate annuity starts payouts immediately and does not offer flexibility or access to funds. Option B is incorrect because while variable annuities provide growth potential, they may not offer the level of flexibility MS Miller desires, especially with market fluctuations. Option C is not recommended because a deferred annuity with a long surrender period locks up the funds and does not align with her desire for flexibility. Washington's suitability model regulation emphasizes matching financial products to the needs and goals of the client while disclosing all risks and providing transparency. Question 8. Topic: Claims and Benefits Administration. An annuity contract includes a beneficiary designation for the spouse of the annuitant. The annuitant passes away and the spouse is entitled to the death benefit. What is the most important action the beneficiary must take to receive the benefit under the terms of the annuity? A. Submit proof of the annuitant's death and provide a copy of the original annuity contract. B. Submit a claim to the insurance company within 12 months of the annuitant's death. C. Immediately transfer the annuity to their name without additional documentation. D. Wait for a notification from the insurance company before taking any action. Answer A. Submit proof of the annuitant's death and provide a copy of the original annuity contract. Explanation: the beneficiary must submit proof of death and the original annuity contract to the insurance company to initiate the claim and receive the death benefit. This ensures that the claim is processed in accordance with the annuity's terms. Option B is not entirely correct, as the exact timing can vary, but the most critical first step is to submit documentation. Option C is incorrect because transferring an annuity to the beneficiary's name typically requires proof of death and other administrative steps. Option D is incorrect because the beneficiary must actively submit a claim to initiate the process. Question 9. Topic: Washington-specific annuity regulations and requirements. Which of the following is a key requirement under Washington state annuity suitability regulations when an insurance agent recommends an annuity to a client? A. The agent must ensure that the annuity is a qualified product for tax purposes. B. The agent must assess the client's financial needs and objectives before recommending an annuity. C. The agent must provide the client with a written report summarizing the annuity's tax advantages. D. The agent must require the client to sign a waiver indicating they are not seeking investment advice. Answer B. The agent must assess the client's financial needs and objectives before recommending an annuity. Explanation: under Washington state annuity suitability regulations, insurance agents are required to assess the client's financial needs, objectives, and risk tolerance before recommending an annuity. This ensures that the product is suitable for the client's situation and helps prevent conflicts of interest. Option is incorrect because suitability regulations focus on the appropriateness of the product, not necessarily whether it is qualified for tax purposes. Option C is incorrect because agents are not required to provide a detailed tax report unless the client asks for it. Option D is not accurate. While suitability must be assessed, agents are not required to have clients sign a waiver about investment advice. Question 10. Topic: Types of annuities. Which of the following best describes a fixed annuity? A. An annuity that offers a guaranteed interest rate and fixed periodic payments. B. An annuity that is tied to a stock market index and can provide variable returns. C. An annuity that guarantees an income stream for a specific period with no further payouts after that time. D. An annuity that allows the purchaser to access the funds without any penalties for the first 10 years. Answer A. An annuity that offers a guaranteed interest rate and fixed periodic payments. Explanation: a fixed annuity provides a guaranteed rate of return and ensures that the annuitant will receive regular, fixed payments for a specified period or for life. This provides financial security since the payments are predictable and not affected by market fluctuations. Option B describes a variable annuity, which is tied to a stock market index or other investment options. Option C describes a period-certain annuity, which only guarantees payments for a set number of years. Option D does not accurately describe any specific type of annuity, as penalties may apply to withdrawals within certain periods, regardless of the annuity type. Question 11. Topic: Annuity payment options. Which of the following payment options provides the most flexibility in terms of withdrawal but is the least predictable in terms of the amount of periodic payments? A. Life only. B. Fixed period. C. Variable annuity. D. Life with period certain. Answer C. Variable annuity. Explanation: a variable annuity allows for more flexibility in terms of withdrawals and potential for growth based on the performance of underlying investments. However, the periodic payments are not guaranteed and fluctuate based on the market performance of the sub-accounts in the annuity. Option A, life only provides fixed payments for life but no flexibility in terms of withdrawals. Option B, fixed period, guarantees fixed payments for a set period, making it more predictable. Option D, life with period certain, guarantees income for life with a minimum number of years, but the payments are still more predictable than those from a variable annuity. Question 12. Topic: Annuity riders and benefits. Which of the following is a feature of an accelerated death benefit rider in an annuity contract? A. It provides extra payments to the annuitant during their lifetime. B. It allows the annuitant to access part of their death benefit if diagnosed with a terminal illness. C. It guarantees a higher death benefit if the annuitant dies within the first year. D. It allows the annuitant to choose a lump sum payout of their annuity's value at death. Answer: B. It allows the annuitant to access part of their death benefit if diagnosed with a terminal illness. Explanation: An accelerated death benefit rider allows the annuitant to access a portion of their death benefit early if they are diagnosed with a terminal illness or meet other qualifying conditions. This rider provides financial assistance when the annuitant needs it most. Option A is incorrect because accelerated death benefit riders focus on death benefits, not lifetime payments. Option C is incorrect because it does not guarantee a higher death benefit in the first year, it simply provides the possibility of early access. Option D is inaccurate because the lump sum payout is typically part of the death benefit, not an option tied to accelerated benefits. Question 13. Topic: Taxation of annuities. Which of the following describes the tax treatment of an annuity purchased with qualified funds? GIRA funds. A. The income from the annuity is tax-free upon withdrawal. B. The entire amount of each payment is taxable as ordinary income. C. The principal is tax-deferred, but the earnings are taxable when withdrawn. D. Only the interest portion of each payment is taxable. Answer: B. The entire amount of each payment is taxable as ordinary income. Explanation: For annuities purchased with qualified funds, the entire payment, both principal and earnings, is taxable as ordinary income when withdrawn. Since the original contributions were made with pre-tax dollars, the annuitant will owe taxes on all the funds when the annuity starts making payouts. Option is incorrect because income from the annuity is not tax-free. Option C is incorrect because, with qualified funds, the entire distribution is taxable. Option D is incorrect because both the principal and earnings are taxed upon withdrawal from a qualified annuity. Question 14. Topic: Suitability regulations. Under the suitability regulation in most states, which of the following actions is required of an agent before recommending an annuity? A. The agent must provide the client with an outline of the annuity's tax advantages. B. The agent must gather information about the client's financial situation, needs, and objectives. C. The agent must guarantee the annuity will outperform other retirement products. D. The agent must offer a fixed annuity as the most conservative option. Answer: B. The agent must gather information about the client's financial situation, needs, and objectives. Explanation: The agent is required to conduct a thorough suitability analysis, gathering information about the client's financial goals, risk tolerance, and overall needs. This ensures the recommended annuity product is suitable for the client's specific situation. Option A is incorrect because an outline of tax advantages is not typically required. Option C is incorrect because agents cannot guarantee investment performance. Option D is incorrect because the agent must recommend the most suitable annuity, not necessarily a fixed one. Question 15. Topic: Regulation of annuities. What does the free look period in an annuity contract refer to? A. A period during which the annuitant can cancel the contract and receive a full refund without penalty. B. A period when the insurer can adjust the annuity's interest rate based on market conditions. C. A period of guaranteed earnings before withdrawals begin. D. A period during which the annuity contract must be reviewed for compliance. Answer A. A period during which the annuitant can cancel the contract and receive a full refund without penalty. Explanation: The free look period allows the annuitant to review the terms of the contract and cancel it within a specified period, typically 30 days, during which they can receive a full refund of premiums without penalty. Option B is incorrect because the free look period does not allow for adjustments to the interest rate. Option C is incorrect because the free look period only applies to the annuitant's right to cancel the contract, not to earnings or withdrawals. Option D is incorrect because the free look period is not for compliance reviews. Question 16. Topic: Risk and return in annuities. Which of the following types of annuities exposes the annuitant to the most risk in terms of fluctuations in payment amounts? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Period certain annuity. Answer: B. Variable annuity. Explanation: a variable annuity exposes the annuitant to the most risk because the periodic payments can fluctuate depending on the performance of the investment options within the annuity. This means the income may vary based on the market, unlike a fixed annuity, which guarantees a set payout. Option A is incorrect because a fixed annuity offers predictable, guaranteed payments. Option C is incorrect because an immediate annuity pays a fixed amount based on the principal, not affected by market fluctuations. Option D is incorrect because a period certain annuity guarantees payments for a set time period, regardless of market conditions. Question 17. Topic: Surrender charges and penalties. Which of the following statements best describes surrender charges in an annuity contract? A. They are fees charged for early withdrawals, which can reduce the overall value of the annuity if withdrawn within a certain time frame. B. They are taxes imposed by the IRS for early withdrawals before the age of 590 onward. C. They are penalties levied by the insurer if the annuity payments are not made on time. D. They are a percentage of the principal amount invested charged when the annuitant dies. Answer A. They are fees charged for early withdrawals, which can reduce the overall value of the annuity if withdrawn within a certain time frame. Explanation: surrender charges are fees imposed by the insurer if the annuitant withdraws funds from the annuity before the specified surrender period ends. These charges decrease over time and are designed to discourage early withdrawals. Option B refers to early withdrawal penalties imposed by the IRS, which are separate from surrender charges. Option C is incorrect because surrender charges are not related to the timeliness of payments. Option D is incorrect because surrender charges apply to early withdrawals, not to the death of the annuitant. Question 18. Topic: Benefits of annuities. Which of the following is a primary advantage of purchasing a fixed annuity? A. The potential for high returns based on stock market performance. B. A guaranteed interest rate and predictable, fixed periodic payments. C. Flexible withdrawal options without any penalties. D. The ability to access the full account balance at any time without restrictions. Answer: B. A guaranteed interest rate and predictable, fixed periodic payments. Explanation: the primary advantage of a fixed annuity is the guarantee of a fixed interest rate and regular, predictable payments. This provides financial security, especially for retirees who need stable income. The payments do not fluctuate, and the annuitant is assured of a set income stream for a predetermined period or for life. Option A describes a variable annuity where returns depend on the performance of the underlying investments, which is not guaranteed. Option C is incorrect because fixed annuities usually have surrender charges and restrictions on withdrawals during the initial period. Option D is incorrect because fixed annuities generally come with restrictions on withdrawals, especially early in the contract period. Question 19. Topic: Annuity payout options. Which annuity payout option guarantees income for the annuitant's entire life, regardless of how long they live? A. Life only. B. Joint and survivor. C. Period certain. D. Life with period certain. Answer A. Life only. Explanation: the life only payout option guarantees income for the annuitant's entire life. The payments will continue for as long as the annuitant lives, but no payments are made to beneficiaries after the annuitant's death. Option B, joint and survivor, provides income for the annuitant's life and continues for the life of their spouse or another designated beneficiary. Option C, period certain, guarantees payments for a fixed number of years but not for the annuitant's life. Option D, life with period certain, guarantees income for life, but if the annuitant dies before the period ends, the remaining payments are made to a beneficiary. Question 20. Topic: Annuities and inflation protection. Which of the following annuity options provides protection against inflation by adjusting the periodic payments over time? A. Fixed annuity. B. Immediate annuity. C. Indexed annuity. D. Inflation indexed annuity. Answer: D. Inflation indexed annuity. Explanation: an inflation indexed annuity, also known as a cost of living adjustment or COLA, annuity adjusts the periodic payments based on an inflation index, helping to preserve the purchasing power of the annuitant's income over time. This feature is particularly valuable in a rising inflation environment. Option A is incorrect because a fixed annuity provides predictable payments but does not adjust for inflation. Option B is incorrect because an immediate annuity starts payments immediately but typically does not offer inflation protection. Option C is incorrect because an indexed annuity offers returns based on a stock market index but does not directly adjust for inflation in the payout. Question 21. Topic: Regulation of annuities. What is the primary goal of state regulation regarding annuity sales? A. To ensure that annuity contracts are sold at the highest possible commission rates. B. To guarantee that insurance companies remain profitable. C. To protect consumers by ensuring that annuity products are suitable for their financial goals and needs. D. To limit the types of annuity products available to consumers. Answer: C. To protect consumers by ensuring that annuity products are suitable for their financial goals and needs. Explanation: State regulations require agents to conduct a suitability analysis before recommending an annuity to ensure the product matches the consumer's financial objectives, risk tolerance, and time horizon. This consumer protection ensures that individuals are not sold products that do not meet their needs. Option A is incorrect because commissions are not the primary focus of regulation. Option B is incorrect because while profitability is important for insurers, consumer protection is the primary goal of regulations. Option D is incorrect because the goal is not to limit options, but to ensure suitability and transparency in sales practices. Question 22. Topic: Annuity surrender and penalties. If an annuitant withdraws funds from their annuity during the surrender period, what is the typical consequence? A. The annuitant will incur taxes and a penalty on the entire amount withdrawn. B. The annuitant will incur surrender charges, but no tax consequences. C. The annuitant will lose the entire principal amount invested. D. The annuitant will receive the full value of their account minus any market performance losses. Answer: B. The annuitant will incur surrender charges but no tax consequences. Explanation: During the surrender period, the annuitant may incur surrender charges, which are fees imposed by the insurance company for early withdrawal. However, taxes may still apply to the amount withdrawn, especially if the annuity was purchased with qualified funds. Option A is incorrect because taxes and penalties apply only if the annuitant withdraws earnings before the age of 591. Option C is incorrect because the annuitant will not lose the entire principal but may face charges and tax consequences. Option D is incorrect because the annuitant will face surrender charges and the full value of the account is subject to potential penalties and taxes. Question 23. Topic: Annuity beneficiary designation. Which of the following best describes the role of a beneficiary in an annuity contract? A. A beneficiary receives a death benefit when the annuitant passes away. B. A beneficiary is responsible for making premium payments to the insurer. C. A beneficiary can change the annuity's payout options. D. A beneficiary determines the interest rate for the annuity. Answer A. A beneficiary receives a death benefit when the annuitant passes away. Explanation: A beneficiary is the person or entity designated to receive any remaining death benefits from the annuity after the annuitant's death. The beneficiary typically receives a lump sum or periodic payments depending on the terms of the annuity contract. Option B is incorrect because the annuitant, not the beneficiary, is responsible for making premium payments. Option C is incorrect because the beneficiary cannot change payout options. They only receive the benefits after the annuitant's death. Option D is incorrect because the beneficiary does not determine the interest rate for the annuity. Question 24. Topic: Taxation of annuities. How are the earnings on a non-qualified annuity taxed? A. They are taxed as ordinary income when withdrawn. B. They are taxed as capital gains. C. They are exempt from taxes if withdrawn before the annuitant turns 590 onwo. D. They are taxed only if the annuitant dies before withdrawals begin. Answer A. They are taxed as ordinary income when withdrawn. Explanation: The earnings on a non-qualified annuity are taxed as ordinary income when withdrawn. The principal is not taxed because it was purchased with after-tax dollars, but the earnings are subject to income tax at the time of withdrawal. Option B is incorrect because earnings on non-qualified annuities are taxed as ordinary income, not capital gains. Option C is incorrect because early withdrawals may trigger a tax penalty in addition to ordinary income tax, regardless of age. Option D is incorrect because taxes are applied on earnings upon withdrawal, not just upon death. Question 25. Topic: Annuity riders. Which of the following riders can provide the annuitant with guaranteed income for life even if the account value falls to zero? A. Guaranteed minimum withdrawal B. Guaranteed minimum income benefit GMIB. C. Long-term care rider. D. Death benefit rider. Answer B. Guaranteed Minimum Income Benefit, GMIB. Explanation. The Guaranteed Minimum Income Benefit (GMIB) rider ensures that the annuitant will receive a minimum amount of income for life, regardless of how the underlying investments perform or if the account value falls to zero. Option A is incorrect because a guaranteed minimum withdrawal benefit provides the annuitant with withdrawals from the annuity up to a specified amount but does not guarantee income for life if the account value depletes. Option C is incorrect because a long-term care rider is designed to provide additional benefits if the annuitant requires long-term care. Option D is incorrect because the death benefit rider provides a payout to the beneficiary upon the annuitant's death, not a guaranteed income stream. Question 26. Topic: Tax deferral. What is a primary benefit of the tax-deferred growth feature of an annuity? A. Interest earned on the annuity is not taxed until the money is withdrawn. B. The annuity principal is tax-free if withdrawn after age 591. C. Earnings from the annuity are exempt from state income tax. D. The annuity payments are taxed at a low rate when received. Answer A. Interest earned on the annuity is not taxed until the money is withdrawn. Explanation. Tax deferral means that earnings on the annuity interest or investment gains are not taxed until they are withdrawn, allowing them to grow without being diminished by taxes in the interim. Option B is incorrect because the principal is never taxed when withdrawn, but earnings are taxed at the time of withdrawal. Option C is incorrect because the tax deferral applies to federal income taxes and some states may still tax the annuity's earnings. Option D is incorrect because annuity payments are taxed as ordinary income when received, not a lower rate. Question 27. Topic: Annuity types. Which type of annuity allows the annuitant to invest in a portfolio of securities with the potential for both high returns and high risk? A. Fixed annuity. B. Immediate annuity. C. Variable annuity. D. Indexed annuity. Answer C. Variable annuity. Explanation. A variable annuity allows the annuitant to invest in a range of securities such as stocks and bonds, which means that the value of the annuity can fluctuate based on market performance. This provides the potential for higher returns, but also comes with greater risk compared to a fixed annuity. Option A is incorrect because a fixed annuity offers guaranteed returns and payments that do not fluctuate with market conditions. Option B is incorrect because an immediate annuity starts payments immediately and does not involve investment in a portfolio. Option D is incorrect because an indexed annuity links the annuity's return to a stock market index but limits the potential for high returns with a cap. Question 28. Topic: Annuity payout methods. Which of the following payout options provides an income stream for the annuitant's life but will stop if the annuitant dies before receiving all of the principal? A. Life only. B. Life with period certain. C. Joint and survivor. D. Fixed period. Answer D. Fixed period. Explanation. A fixed period option provides payments for a predetermined number of years, such as 10 or 20 years. If the annuitant dies before receiving all the payments, the remaining payments go to a beneficiary. If the annuitant lives past the specified period, they will continue receiving payments until death. Option A is incorrect because life-only payments continue for the annuitant's life but stop immediately upon their death, even if they haven't received all their principal. Option B is incorrect because life with period certain ensures payments for a life but with a guaranteed period. If the annuitant dies early, the beneficiary receives the remaining payments. Option C is incorrect because joint and survivor continues payments to the surviving spouse after the annuitant's death, regardless of the principal received. Question 29. Topic: Annuity surrender charges. What typically occurs if an annuitant withdraws funds from an annuity within the first few years of the contract? A. The annuitant will receive a penalty-free withdrawal. B. The annuitant may face surrender charges on the amount withdrawn. C. The annuitant will lose all interest earned. D. The annuitant will be exempt from taxes on any withdrawals. Answer B. The annuitant may face surrender charges on the amount withdrawn. Explanation. Surrender charges are fees that insurance companies impose if the annuitant withdraws funds during the early years of the contract, typically the first 5 to 7 years. These charges decrease over time and may apply even if the annuitant withdraws less than the total balance. Option is incorrect because early withdrawals typically come with penalties or charges. Option C is incorrect because interest is typically subject to tax upon withdrawal, but the principal remains intact. Option D is incorrect because early withdrawals may incur both surrender charges and tax penalties, especially if they are not qualified withdrawals. Question 30. Topic: Annuities and estate planning. Which of the following is a key benefit of including an annuity in an estate plan? A. An annuity can help avoid probate by designating beneficiaries. B. An annuity guarantees the annuitant a higher death benefit than life insurance. C. An annuity can replace all retirement savings if properly structured. D. An annuity provides tax-free income for the annuitant's heirs. Answer A. An annuity can help avoid probate by designating beneficiaries. Explanation. One of the key benefits of an annuity in estate planning is that it allows the annuitant to designate beneficiaries. Upon death, the beneficiary can receive the death benefit directly without going through probate. Option B is incorrect because an annuity does not necessarily guarantee a higher death benefit than life insurance. Life insurance typically has a larger death benefit. Option C is incorrect because an annuity cannot replace all retirement savings. It is part of a broader retirement strategy. Option D is incorrect because the income from an annuity is subject to income taxes, although it may have certain estate planning advantages.